So what does it mean to do an asset purchase when buying a business? Is it better than a stock sale? Why do you do an asset purchase versus a stock sale? What about working capital, equipment, inventory? Are they factored into the price? What does it all mean? How does it all work? In today's video, I'll discuss the biggest mistakes buyers make when buying a business and how you can avoid them. Let's get to it. Everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase your wealth by buying a profitable business, or if you are a W-2 employee looking to leave the rat race by purchasing a profitable business, then you are in the right place. And please subscribe to my channel. Don't forget to hit the bell and you'll be notified every Thursday when a new video comes out. All right, let's get into it. So, there are two primary ways in which buyers can buy a business, and those are a stock sale, or which is an equity transaction, or an asset sale. So when you're doing a stock sale, what you're buying as a buyer is the legal entity altogether, which the assets and the liabilities of the company. So there are reasons why a buyer would want to do that, and this is probably not the subject of this video because I'm going to talk more about the asset, but there's a stock sale and there's the asset sale in which you're actually correspondingly, you're buying certain assets of the business as a product of their cash flow and as agreed upon by the buyer and the seller. So what you should know is that when you're buying, actually, about once a week, I get an email from somebody saying, hey, I want to, because I'm a business broker, so I sell businesses. I want to sell my business, and we get into this conversation and we start talking about, and they have these preconceived notions of how much the business is worth. And I always ask them, how much do you think your business is worth? Well, I usually get answers like, well, I've done some homework. I have my company valued by a CPA, and I was told that my business is worth 5 times cash flow plus, all of my assets. I said, good. Well, that is usually wrong, because what happens is what you're buying as a buyer is a stream of cash flow. Think about it. A business is nothing more than a fragile ecosystem. It's a way to produce cash flow. And what you have the assets for in the balance sheet is only there to produce cash flow. If the assets are not giving you the return in the assets by producing the revenue and the cash flow that you need, then why do you have the assets there? So keep in mind that when we say an asset sale, we're actually cherry picking what are the assets of a business that you want as a buyer. If you do it in an asset purchase, you want the customer base, you want the key accounts, you want the system of deliverables, the entire way that they do business, the goodwill. You're buying the cash flow and the goodwill plus all the book of clients if you're in a service delivery model. If you're in a manufacturing model, you're buying all the intangibles, like some of the equipment that is necessary to carry on the business, plus inventory and etc. So what you need to know, what's important is you're buying a system. In fact, if you're gonna get this system financed by an SBA lender, what the SBA lender is actually doing a cash flow loan. They're not as interested, the assets are actually incidental to the cash flow. The most important criteria that a lender will evaluate when looking at a business is its ability to produce cash flow at the rate of 1.25 or better against the debt service. It doesn't really matter how much assets you have in the balance sheet. If the net income isn't there, how are you as the buyer going to be able to finance with the cash flow the debt that you're acquiring for the business, which is also a liability? So let's talk about assets and equipment. So actually, before we get into it, there's 3 things we're going to talk about right now as far as an asset purchase. We're going to talk about assets and equipment, working capital, and inventory. So with that, assets and equipment. First, you need to understand the formula for the balance sheet. The balance sheet is the most important financial statement in the set of financial statements that usually, that's how companies are run. You got, profit and loss, your statement of cash flows, and the balance sheet. The balance sheet is the only permanent document. What are assets? Assets equals liability plus equity. So As I said, to the owner that was telling me, hey, my business is worth, in this particular scenario, the business was generating about $250,000 worth of cash flow, so to say. That was the definition of cash flow by their own calculations. I had not evaluated their numbers. I didn't know that whether those were true numbers to the tax returns. This was just the seller saying what the business is worth. So $250,000 a year, he thought it was worth $1.25 million or 5 times his cash flow, and he wanted $1 million for his assets. I said, wait a minute. So I took a look at the balance sheet and I realized that even though he said that the assets of the business were $1 million, it wasn't true, because he might have said $1 million when he purchased them X amount of times years ago, but they were already depreciated by $800,000. Think about it. Assets are depreciated over time because as every year they use them, they start to lose value. So the net book value of those assets were only $200,000. Why would anybody want to buy a used asset and pay retail for it? It doesn't make sense, right? So what you need to know as a buyer is that the only purpose of the assets in the balance sheet is to produce cash flow. And here's a good mark of cash flow, assets, and revenue. Do you need help with buying or selling a business? I am here to help you. Please, all you need to do is drop me a comment below or send me an email. My email address will be in the description section of this video. Let's connect. So say a business is worth, so here's what you need to remember. In most service delivery models in the service industry, your seller discretionary earnings should at 3.5 times should be equal 1 times revenue. Keep that as a rule of thumb. So a business out there in the marketplace selling for $1 million, and it has $350,000 worth of annual seller discretionary earnings, is trading 3 times the purchase price, and the comparable sales tell me that it's actually worth 3 times seller discretionary earnings. That tells me that the buyer will be making 35 cents for every dollar's worth of revenue, which means that it's high utilization of those assets that are sitting on the balance sheet, regardless of the depreciable value. Okay? So, hope you got that. Here's what you need to remember after all of that. If the assets don't produce cash flow, what is the purpose of the assets? So, here's the thing. I look at the assets. The assets are always included. The equipment that is necessary to generate the revenue, it's always part of the purchase price. How we value businesses is more than likely a multiple of either seller discretionary earnings or EBITDA, which is a little higher. So either a multiple of seller discretionary earnings, anywhere from 1.5 to 10 times, depending on how big the revenue, what industry vertical, and plus and the seller gets to keep the cash flow and the AR and the excess inventory, and it gets traded between the buyers. So let's stop there for now. Okay, number 2 is working capital. So working capital is an asset. Working capital is an understanding of the liquidity of a business. Now, there's 2 ways to express the working capital. One is as a percentage, as a ratio, which is your current assets divided into your current liabilities, and what lenders want to see is at least 1.5 times or 50% more current assets than current liabilities. And the other one is expressed as a dollar value, which is the difference between your current assets minus your current liabilities expressed as a numerical value. Now, when we're looking into, if you're going to do a stock sale, the excess of working capital is as defined in the calculations of the valuations would always stay with the seller. But when you do an asset purchase, the working capital, it's important for you to know because it's an indication of the health of the business. Now, when you're doing in a working capital, you want to understand how the assets are returning on the actual investment of the assets. So what's included usually, it's that the working capital on the business, it's already part of the deal. Remember, you're not buying the stock, you're not buying the shell, you're actually buying the cash flow. So that'll be included, and it'll be you're basically, the seller gets to keep their balance sheet. You're going to have your own balance sheet. You're going to cherry pick those things that make sense, but the working capital is already included. Now, here's one thing that you need to know: inventory. Now, there is a certain amount of inventory that is necessary to carry on businesses. That's defined usually quarter by quarter on a 90-day basis. So when we're actually looking, if I'm representing the buyer and we're looking for a business to buy, and we're actually going in the process of defining what our offer is going to be, we always want to know, is there any excess inventory? And that usually gets, if the broker representing the seller did a good job, they all need to understand what the normal inventory levels will be for the first 90 days that the buyer buys the business. Anything beyond 90 days that the seller keeps on hand, they usually keep or sell to the buyer separate from the transaction. So you're going to have the multiple of seller discretionary earnings. We're talking for a business that is less than 3 million, or between 1 and 3 million, or a multiple of EBITDA, plus the excess inventory above and beyond what the buyer will need for the first 90 days. So that's what you need to know. So what are some of the biggest mistakes that buyers make when buying a business? They get, if the buyer is not represented by somebody who knows, and let's say the biggest mistake, as I say, is an overinflated purchase price, particularly if the business is not represented by a professional business broker. Remember, the beauty is in the eye of the beholder. To the seller, the business is worth a whole lot more than what it's really worth. So let's go back to that example I told you about. Business that was truly worth probably 3 times cash flow, so $750,000. That's what the business would be financeable by a lender, and yet the seller thinks the business is worth $1.25 million plus $1 million worth of assets. So think about that. Look at the gap. Okay, so biggest mistake: overpaying for a business. The second mistake is really trusting that the seller's financials are okay without really looking into the tax returns. Trust but verify. So what I see that a lot of is it's unrealistic expectations on a lot of things, of the true value of the business, and overpaying on the business. Also underestimating how long it takes to close the business. So those are the biggest things that I know. So remember that the biggest mistake is overpaying for the business. Hopefully this video was helpful to you guys. At the time, I'm giving away my cash flow calculator. This is a great tool I use every week with helping buyers calculate the cash flow on any deal after including the debt service, which is key in getting the business that you want financed by a lender. If you want it, all you have to do is click on the link below. It's yours to keep and use, and it's my gift to you. I hope you enjoy it.